reverse repo facility at the Federal Reserve is finally empty. After a $2.5 trillion spike in balances held at the reverse repo facility at the Fed, the total balances have finally dwindled down basically to zero. Balances will continue to bounce around a little bit. As you can see, as of Wednesday, August 20th, it was about 35 billion. But zooming out, you can see it's well under where it's been for the last couple of years and back down to normal levels again. And that $2.5 trillion that was in there at the peak in 2022 has now gone back into the financial system. The dollars that have been sitting in this facility have been providing the excess liquidity specifically for the US government's insatiable appetite for borrowing for the last couple of years. Now that this facility is drained, the question is, where will the liquidity come from now? Because the government is not stopping its borrowing. In fact, it's not even slowing down, it's speeding up. As a recap, the Federal Reserve used the reverse repo facility as a way to absorb the excess cash deposits that flooded the banking system after all the money printing during 2020. Because cash deposits are a liability for banks, they need to go get assets to offset those liabilities. But the Fed, through its rounds of QE, had just bought up all of the assets off the market, which meant that banks were having a very tough time finding collateral. So the Federal Reserve opened up the reverse repo facility and said, hey banks, park your cash here, we'll give you a nice interest rate, and in return for that cash, we'll temporarily give you the collateral, the assets that you need. It was a sweet deal for banks because they were getting literally risk-free money from the Federal Reserve by parking their cash here. But as inflation rose, interest rates rose, and government borrowing kept on increasing, the interest rates on T-bills slowly but surely got higher than the interest rate that was getting paid in the reverse repo facility, which meant starting in 2023, you saw money start to slowly leave the reverse repo facility because it was finding better deals just lending to the US government. Again, this is all short-term cash. This is stuff like money market funds. It wants a place where it's going to be easily accessible. I can get the cash out very soon. I'm going to get the highest interest rate possible and the lowest risk of default. And so the US government has been able to borrow essentially as much as it wants as long as it's issuing T-bills, very short-term debt, because it was just relying on the trillions of dollars that was leaving the reverse repo facility to get T-bills instead. But now there's nothing left in the reverse repo facility. We're back to the situation that we were prior to all of the money printing in 2020. The problem is, by the end of September, the Treasury is borrowing another $1 trillion, and by the end of the year, they're tacking on another $600 billion on top of that. And because President Trump has been adamant, doing everything he possibly can to try and get the Federal Reserve to lower rates, he's not rolling that debt over or borrowing long-term debt. He has committed to only issuing short-term debt. That way, once interest rates do go down, he can roll out that short-term debt over into lower interest, cheaper debt. But where is the $1.5 trillion going to come from for all of this short-term debt? Well, the first place that liquidity might come from is from the Genius Act. One reason why this administration has been so pro-crypto is because it wants to ensure that at the foundation of all of that is treasuries. In other words, dollars being lent to the US government. More dollars being lent to them, the cheaper their borrowing is. That is the reason for the Genius Act and this administration being so pro-crypto. But it's not enough. The second place we can look is a bill that was recently introduced to Congress called the FAIR Act, the Fiscal Accountability for Interest on Reserves Act. I don't know why they always have to make it a stupid acronym, but basically this bill proposes eliminating the ability of the Federal Reserve to pay interest on reserve balances that are held at the Fed. Right now, banks hold a total of $3.3 trillion in reserves at the Federal Reserve. And you can see that prior to 2008, banks did not hold reserves at the Fed. So what in the world changed that caused so many trillions of dollars to just go sit at the Fed? Well, the Federal Reserve got the authorization from Congress to start paying interest on reserves. So just like the reverse repo facility, if you are a bank sitting on cash, you're like, hey, what are we going to do with all these reserves? give them to the Fed, and the Fed pays you interest. Now, the reason this rule was changed in 2008 so the Fed could start paying interest on reserves held there was because of all the QE. They wanted an easier way to be able to make sure that the federal funds rate stayed within the range that they wanted. Prior to 2008, the way the Federal Reserve would make sure the federal funds rate stayed in between their target range was strictly through open market operations. And so the Federal Reserve, every day, they would be buying and selling government securities. Little mini bouts of QE and QT all day long. When they're buying treasuries off the open market, that means they're injecting new cash into the market, making it easier, helping interest rates stay lower. And when they are selling government securities, they're taking cash out of the market, making cash more scarce, driving interest rates up. So they would conduct open market operations in order to make sure that the federal funds rate stayed within their target range. But starting in 2008, because there was so much cash injected into the system, they just thought, hey, this is going to be a lot easier to be able to make sure that we can maintain the federal funds rate if we can just say, hey, we're going to pay interest on reserves. So if you can't do it amongst yourselves, give us the reserves and we'll pay you. Now, this bill would eliminate the Federal Reserve's ability to pay interest on reserves, which means we've got $3.3 trillion sitting at the Federal Reserve right now that would have to go look elsewhere for a return on its money. And yes, basically all of that would go into T-bills and treasuries. Now, if you're wondering how the Federal Reserve would be able to maintain the federal funds rate without paying interest on overnight reserve balances at the Fed, they would just go back to open market operations. In other words, manipulating their balance sheet in order to change the reserves in the system to target the interest rate range. It is possible that reserves right now are still way higher than they would need to be for the Federal Reserve to be able to do this easily. But either way, if this bill gets passed, they amend the Federal Reserve so the Fed stops paying interest on reserves, $3 trillion floods out of the Fed, goes buys T-bills, go buy treasuries, goes and does other stuff. Lots of easing, lots of new money being put to work in the economy. Now, the next and most likely option, in my opinion, is this. This is the Fed's balance sheet. We just see them return to QE and this thing starts to grow again. If the government keeps on borrowing more and more, driving interest rates high, we get somebody else in charge at the Federal Reserve. They just start up QE again. They become the lender to the US government at the rate the government wants. I think this is more likely because it's much easier. The Fed's been doing QE for like 2 decades now. It would not require a huge change to the banking system or the way the Fed operates. It wouldn't require financial institutions to get used to the Fed doing open market operations and the federal funds rate being more volatile. And it would accomplish the same goal. The government needs somebody to borrow from. They can borrow from the Fed. I think this is the most likely, but probably not under the current leadership at the Fed. Now, obviously, even this is just a short-term band-aid because quantitative easing doesn't necessarily mean interest rates stay lower. Quantitative easing is where the Fed says we'll buy a certain number of bonds, but a lot of other people could be selling those bonds, which means that even if QE is happening, you could see something like the 10-year yield still go higher because there's more selling than there is buying, which means that the long game here, with so much government debt in T-bills right now, I think yield curve control is likely the long-term solution they'll use. Yield curve control is like QE, but on steroids. It's where the Fed says, we don't care how many, let's say 10-year treasuries we have to buy. We're gonna buy as many of them as necessary to make sure the yield stays at 4%. Or 3%, or 2%, or whatever they choose. Which means the rest of the world could sell an unlimited amount of them and the Fed would just buy them all at that price. In order for the US government to be able to successfully roll over the trillions of dollars of debt that it has in short-term debt right now at an interest rate that is lower than the current market rate, I think yield curve control is more likely than not, especially considering the fact they did this in the 40s and the 50s last time we were here, especially considering the fact that the next year or two, we're gonna see higher prices and the market reaction is going to be push interest rates higher. So as the Fed tries to lower rates under pressure from Trump, it's only gonna push down the low end of the curve, not going to do anything to help them roll over all the debt into longer term debt, which means balance sheet probably goes to the moon. As always, thank you so much for watching. Have a great day.